Hello guys. In the last sessions we talked about the basics of forex trading, and in this session we'll be talking about the main things about trading forex. So the first thing we'll be talking about is moving average. In the last session we covered the different basics that will help you understand better that from trading from this particular level. So the first thing we'll be talking about is indicators. We learn about indicators. So indicators are different set of tools that make trading easy. Indicators, they are tools that we can use to forecast future price action. They help you know which direction the market is going. They help you know which direction market is going, so as to enable you to be able to place your trade so you can make profit. There are different kinds of indicators, several of them. We have the moving average indicator, we have stochastic oscillator, we have Bollinger Bands, we have relative strength index, we have MACD MACD, we have average true range, we have Ichimoku indicator, we have Elliott waves, we have Fibonacci retracement. But the first one we'll be starting with is moving average indicator. So now under moving average indicator we have two types of indicator moving average. We have simple moving average, and we have exponential moving average. So moving average is an indicator that calculates the average closing price of a particular currency, average closing price of a particular currency pair over the last periods. Okay, this is just the mass. I won't explain the mass. I will drop the link to this PDF link where you can get this PDF to make things easier for you. Because I'm explaining the mass behind moving average will take a lot of time, so I'll just skip the mass and go straight to how to make use of the tool, moving average tool, on your MetaTrader app. So like I said before, we have two types: simple moving average and exponential moving average. Now the first thing we need to do to be able to make use of moving average indicator is to go to our MetaTrader 4 or MT4 or MT5, depending on what you're using, but we're going to depending on what you're using. So let's go to MT4, then from there we'll take the next steps. MetaTrader, let's open MetaTrader 5, right? Okay, it's still loading. Let it load. I think my network here is bad. Let me restart it. Okay. Okay. Let's make use of GBP USD. GBP. The markets are currently closed because it is weekend, but I can still make use of the tool. Yes. Okay. Now, so this is GBP USD, and if you notice, there's no single no indicator or anything in the chart. It's a bare clean chart. So the first thing you need to do to add your indicators is to click on this F sign, here, let me use red to make it clearer. This F sign, right? So the first thing you do is to click on this. So we click on this. When we click on this, now we scroll through to see moving average. So we scroll. Now we scroll, moving average indicator, moving average. Now see moving average here, so we click on it. Now for the moving average, we have 4 different numbers that will be adding for this period. Like I told you before, it calculates the period, the movement of price over certain periods. So we're going to be using 4 different periods. The first one we're going to be using is number 7. So we clean this 60 and put 7. We change the number to red. to red, right? After that, you click on OK. Immediately you notice that a line has appeared here. This line here represents the 7 moving average. The next one we'll add now is we go back, we repeat the same process. Click on this sign, click on this F plus sign, click on moving average, and we'll change this 7 to 14. Change the color to blue, right? Now this pixel just represents how big the line will be. If I change it to 2, you will notice that it is bigger than it is smaller than the other one that we use 3 pixel. Like I told you, we have different kinds of moving average, simple and exponential, but I'm going to make use of simple. So we click on done. Now you notice that it has reflected. So now you can notice both the blue moving average and the red moving average. That is, remember, the red moving average represents 14 period. Blue moving average represents the 7 period, right? So we have added both. We have added the 14 moving average. We have added the 7 moving average. So now we need to add 2 more. Then I'll explain the significance of these moving averages to you. So now we still click on this F sign again. Click on this F plus sign. Click on moving average. We change this now to 89. Change the color to black. You can use any color of your choice, but it is better we make use of these colors to make it easier for us. Let's make the pixel 3 and click on done. Right, then the last moving average we need to add is 200 moving average. Click on this 200 moving average. Then let's make the color let's say green. Right, so now we have added the 4 moving averages we need, which is 7, 14, 89 and 200 moving averages. So now I'll explain the significance of these moving averages and what they represent when trading. So now anytime you notice that the red, which is the 14 moving average, crosses, if you don't, let me use color. So anytime you notice that this is, let's say this is the blue, which is 7 moving average. Anytime you notice that the red moving average crosses the blue moving average from up to down like this, it represents a sell signal when you are making use of moving average. Anytime you notice that the red let's see, this is the red, notice that the red moving average crosses the blue moving average from down to up, it means it's a buy signal. Right, that's what it represents. So now I've explained. Let's do practical examples. Let me show you guys. So now if you notice in this point here, right, yes, if you notice, immediately this red moving average crossed the blue moving average around this point, the market went down. As you can see here, that is, price went down. Right, now let me look for another one and explain. Let me look for another one. If you notice, immediately the red moving average crossed the blue moving average at this point from down to up, the market started buying. Market bought. You understand? Let me look for another example and explain so I can understand, grasp the whole thing very well. Now if you notice at this point here, as the red moving average crossed the blue moving average, the price went down. The market went down. Indicating that it's a sell signal. Right? Now let's check for another one. See another example again. Immediately the red moving average crossed the blue from up to down, sell. The market went massively down. You understand? So this is what indicators do for you. See this one. Immediately the red crossed the blue moving average from down to up. The market went up and bought. Buy signal. Signal. You understand? So that's also the significance of both the red and the blue indicator moving averages. Now, how about those other numbers? You know, we added 4 indicators. We added 7 moving average, 14 moving average. We added 89 moving average and added 200 moving average. So what does the two other moving averages represent? Now, the 89 moving averages which we use, the 89 moving average, right, which is the one that is black. 89 moving averages tells us when we are entering a new trend, either from the uptrend to the downtrend or from the downtrend to the uptrend. While the 200 moving average, which is the green, tells us the particular trend we are in, if we are in an uptrend or we're in a downtrend. Now, let me explain what an uptrend and a downtrend is. An uptrend represents when the market is buying. Uptrend means when the market is buying, right? That's what uptrend means. The market is on the higher side, is mostly buying. Then a downtrend represents when the market is selling. Downtrend represents when the market is selling. That's what it means. That is the candles are mostly going down. So now the work of the 200 moving average is to tell us what particular trend we are currently in. If the candles are above the 200 moving average, it means it means we are in an uptrend. That is to say, if the red and the blue moving averages are above the black moving average, which is the 200 moving average, it means that we are in an uptrend. Like in this case, we can see here, we can look at this case here, we'll notice that this is our 200 moving average, right, which is the green moving average. You will notice that both the black, which is the 89 moving average, the red 7 moving average, and the blue, which is the 14 moving average, are all above the 200 moving average, telling us that we are clearly in an uptrend. If you notice, everything here around this region was above it. We're in an uptrend, right? Then now let me show an example for a downtrend. A downtrend is when all the candles are below the green moving average. Like if you can see in this case here, see, this is our 200 moving average, this green one, right? You notice both the black, the red, and the blue are all below the 200 moving average, which is telling us that we are clearly in a downtrend. That is just what it means. We are clearly in a downtrend. So that's also the significance. And one thing about you need to know about trading is that you always understand that the trend is your friend. Meaning, if the market is an uptrend, it is always better to buy. So you look for more buying opportunities in an uptrend, right? Then you look for more selling opportunities in a downtrend. In a downtrend, you look for more selling opportunities. So now, what's the significance of this information with respect to moving average? So let's say we are in a downtrend. As you can see in this case, all the candles are below. This is our 200 moving average, right? 200 moving average, 200 MA, and all the candles are below both the black, the blue, and the red are below the 200 moving average. So now what is advisable for someone? It's advisable that if you're looking for opportunities, if you look for opportunities to sell, you're looking for where opportunities to sell, meaning you're looking for where the red moving average crosses the blue moving average. And if you can see from this case here, this is one point where the red moving average crosses the blue moving average. So you just begin to look for points where the red moving average crosses the blue moving average, so that you can be able to enter trades. You understand? You just check the moving average indicator to check to see where red moving average crosses the blue moving average. So if you scan through this part, I don't think you will see any opportunity here. So we'll check. This is just for example purpose. You understand? So you check, right? See an example here. With time, I will teach you guys about what they call it, price action. If once you learn about candlestick analysis, this pattern here is a sell pattern. We call it inside bar pattern. But when I get to that point, I will explain it better so that you will understand better. You understand? So, but that's by the way. We're talking about moving average indicator for now. So now in this case, we can see that the candles, that is the other moving averages, are below the 200 moving average, right? So like I said, you look for where the red crosses the blue to enter, and this is an example. The red moving average crosses the blue moving average. So now you mark the point where the red moving average crosses the blue moving average, right? See this point again. Red moving average cross the blue moving average here. You take note of the point where the moving average crossed it. So you now pick a point. If in this, like we are selling now, pick a point below above it as your stop loss SL, right? Then you go back or you look for a point closer. You calculate pips depending on how you want your target to be, and pick a closer point as your take profit. Let's say we are picking this point here as our TP. So we mark this number as our TP, we mark this number as our stop loss, and we open the trade. Remember I told you guys about this point. You go to this plus sign here and open it and enter your points for your trades. So that was it. So we saw a point where the red moving average crossed the blue moving average in a downtrend, right? So first of all, you take note of the trend that is currently happening in the market. You look for golden cross. You pick a point above, if it's in the case of a downtrend, that's where we are selling, a point above the red, above where the cross happened, where the golden cross happened, which is here. You pick a point above it as your stop loss, and you calculate the amount of pips. If you want to make, let's say, $50, $100, depending on the lot size you are using, your trading plan, and how much you want to make. Then you pick your take profit, mark both stop loss, mark both take profits, and you go to enter the market. So now let me make example of a buy trend. Like I said, if you're in a buying trend, you're looking for what? Buying opportunities. Buy trends when the candles are above the 200 moving average, which is the green one, right? Above the 200 moving average. Okay, yeah, see an example here. This is our 200 moving average, right? Everything is above it. We remove the blue moving average, the red moving average, and the black moving average are all above the 200 moving average, which is the one that tells us the particular trend we are in. So what do we do next? We have mastered what trend we are in. So we are looking for buying opportunities. Like I said, you check for golden cross where the red moving average crosses the blue moving average from down to up. See a perfect example here. So like I said, we pick a point below where the golden cross happened. Let's say we pick here as our stop loss. Then we pick a point above, give a little distance above as our take profit, right? or if possible self, you can check for a point, a previous point where a golden cross happened and take it as your take profit. But since this is a case, for example, I'll just pick a point above as our take profit. So this point below our golden cross, we take it as our stop loss, and this point above, we take it as our take profit, TP. You understand this point here? So we mark these numbers. We mark these numbers, our take profit and our stop loss, and we remember we go here and enter, execute the trade, put value for stop loss, put the value for take profit, and execute the trade, and wait for it to either hit our stop loss or take profit. But another thing I want you guys to know is that there are some times that even though we are clearly in an uptrend, there are times that you will notice that there are opportunities for, let's say when you're in an uptrend, you notice that golden cross has happened, let me say, to show a sell signal, or when a downtrend and golden cross happens to show that there's buying opportunities. Let me show you an example. Like if you can see from this case here, we notice that we are clearly in an uptrend, but the golden cross crossed the red moving average, crossed the blue moving average from up to down. Like say in this case, it's showing us a sell signal. You can take the risk sometimes. You can take the risk. You understand? So we can pick here as our stop loss and pick somewhere here, maybe here as our take profit. This is for this is showing us a sell signal. You understand? Although we are clearly in a buy trend. You understand? So let me check for another example of where a golden cross happened, where we are clearly in a downtrend, but we saw a signal for buy. Let me check. Okay, like see this case here, we are clearly in a downtrend. See our 200 moving average here, 200 MA. But if you notice that the red moving average crossed the blue moving average from down to up, indicating a sell signal. So you just pick. But in these cases, most of the time, this kind of moves that is going in reverse to the current trend we are in, is most of the time it's mostly what they call it, retracements. It will still continue going in accordance with the current trend. It's just that sometimes the market doesn't just continue moving. If it's buying, it won't buy forever. If it's selling, it won't sell forever. If it goes, so there's something we call impulsive move, something we call continuation or retracement. You understand? Impulsive move is when the market moves, buys for a very long time, like in this case here. You see market was just selling. See these red candles, it kept on selling. Then before you know it, it began to retrace for some time. All these moves are retracements. There's all these other candles forming. So it does not mean that you cannot make money from those particular moves. You understand? So that's just it for moving averages. So I think I've explained. Remember, I talked about 7 moving average, 14 moving average, 89 moving average, 200 moving average, and their significance. I talked about when to enter market, when to come out. I talked about golden crosses. I talked about entering trades even though we are in a trend that is not in accordance with the cross. Like sometimes, like I said, you can see a golden cross when you are clearing a buy trend. You can see selling opportunities. You can see a golden cross to sell, to buy when we are clearing in a downtrend, which is for selling. So it does not mean you shouldn't take those risks, just that you take those risks with caution. I hope you have been able to understand this particular example. If you have any questions, you can just drop them in the comment sections of this particular video. Thank you.